What if I told you that trying to be clever with your money is like, it's actually the exact thing keeping you from getting wealthy?
Yeah, that is a hard truth for a lot of people to swallow.
It really is. I mean, every single year, millions of people surrender just billions of dollars in fees to these so-called financial experts, right?
Yeah,
Hoping that they can somehow outsmart the stock market.
right. And they do it completely unaware that doing absolutely nothing will almost always make them wealthier.
Exactly. And you know the feeling. You open a brokerage app or you read some financial article, and it's just this massive wall of jargon.
Oh, moving averages, yield
Yeah.
curves,
Yeah, all
derivatives.
of it. The entire industry just seems engineered to send this very specific message to you, which is like, this is incredibly complicated, it's super dangerous, and you are simply not equipped to manage it on your own.
Well, it's an industry that deliberately thrives on that complexity. Because, I mean, if the system is complex, you naturally feel compelled to pay a toll to someone who clubs they can navigate it for you. It creates this really powerful gatekeeping effect. And it leaves most people feeling completely paralyzed, intimidated, and ultimately, separated from the growth of their own wealth.
But what if the secret to building wealth isn't some complex algorithm? What if it's actually this paced, aggressively simple path right through the middle of all that noise?
That is a big question.
Right, and today, our mission on this deep dive is to extract the core roadmap to financial independence. We're doing this by looking at a really fascinating stack of sources centered around J.L. Collins's highly acclaimed book, The Simple Path to Wealth.
It's such a great book.
It is. We have excerpts from his writings, his foundational case studies, and, to keep us honest here, we are weighing his philosophy against critical economic analyses of his methods.
It's a phenomenal collection of material, and Collins is a seasoned financial veteran, but what makes his approach so compelling is really its origin story.
You have the letters.
Right. He originally developed this philosophy as a series of letters to his teenage daughter. He wanted to give her this straightforward, actionable system that didn't require her to, obsess over financial news every morning.
Nobody wants to do that.
Exactly. He wanted to design a strategy based on complete financial self-reliance.
And that is exactly the vibe we are channeling today. We are not here to give you some dry lecture on macroeconomic theory.
Please no.
Yeah, we are exploring how extreme simplicity can actually engineer a rich, free life. But to build that kind of life, you need a stable foundation, right?
You absolutely do.
You cannot build a fortress of wealth if the ground beneath you is actively caving in. So we are starting our deep dive exactly where Collins begins his orientation, which is the harsh reality of debt.
And Collins is completely uncompromising on this front. If you are carrying consumer debt, he basically argues that you are fundamentally starting in the negative.
Yeah, in our source material, he describes debt as an unacceptable burden.
Right. He doesn't just view it as this mathematical disadvantage. He views it as a massive, suffocating barrier to your life success. Debt diminishes your lifestyle choices, and it drastically skyrockets your baseline stress level.
Oh, for sure.
I mean, think about the mechanics of it. If you owe thousands on a credit card, you cannot easily quit a toxic job.
Right, you're trapped.
You cannot take a calculated risk on a new business venture. Your future labor has literally already been sold to service that monthly payment.
And it goes much further than just high-interest credit cards, too. I mean, he targets the sacred cows of the financial world. He completely attacks the concept of what society calls, good debt.
Yeah, he really goes after it.
He cautions against buying more house than you strictly need. He specifically calls out the long-term compounding drag of a massive mortgage, and he even warns about the heavy burden of student loans on young borrowers.
Which is controversial.
Very.
Yeah.
But for him, the strategy is aggressive and it's singular. You prioritize debt repayment based on the highest interest rates, and you reject any psychological crutches or debt consolidation services that just make you feel like comfortable staying in the red.
Yeah, he views debt as a fire in your kitchen. You have to put it out before you can even think about cooking dinner.
Okay, let's unpack this. Because this absolute visceral rejection of all debt is where our sources really start to clash.
They really do.
When we look at the critical thinking notes provided, we have to ask you, is debt always an anchor dragging you down? Or can it sometimes be a sail catching the wind?
That's a great way to put it.
Because if we look at what macroeconomic analysts are saying, we have articles referenced here from The Economist and research from the National Bureau of Economic Research. They argue that strategic borrowing is actually a primary driver of wealth creation.
This raises an important question, doesn't it? We are looking at two entirely different operating paradigms here. On one side, you have the purely mathematical perspective of the economists. They focus on the mechanics of leverage.
Right, the spread.
Exactly.
Mm.
If you can secure a mortgage at, say, a 4% interest rate, and you leave your capital invested in a market that yields historically around 8 to 10%, you are mathematically capturing the spread between those two numbers.
Your money is literally working harder than your debt is costing you.
Precisely. And regarding the NBER's stance on student loans, human capital is an asset.
Right.
Taking on $60,000 in debt to acquire, like an engineering degree, might increase your lifetime earning potential by millions. Mathematically, that is a highly rational, high-yield investment in yourself.
And beyond that, a fixed-rate mortgage is essentially a built-in hedge against inflation. I mean, over 30 years, as inflation naturally rises, the real purchasing power of the money you use to pay back the bank actually decreases.
Yep.
You are paying them back with cheaper dollars.
Mhm.
It's a calculated financial tool.
It is absolutely a tool, and the math of leverage is totally sound. But, Collins is optimizing for a completely different set of variables.
Right, he's not looking at just the math.
No. The economists are optimizing for maximum net worth through mathematical leverage. Collins is optimizing for absolute psychological freedom and risk aversion.
Which is huge.
Because the mechanism of leverage works in both directions, right? It amplifies gains, but it also amplifies catastrophes.
Yeah, if a severe recession hits, your investments plummet, and you simultaneously lose your job, that mathematically optimized good debt still demands cash every single month.
Exactly. So what is crucial for you, the listener, to evaluate here is your own psychological makeup. Are you trying to squeeze every single penny of potential net worth out of the economy? Or are you trying to buy the flexibility to sleep soundly at night?
Collins is basically selling sleep.
He is. He's selling a good night's sleep.
Which is a perfect pivot, actually, because psychological endurance is really the invisible thread tying this whole philosophy together. Let's say you've navigated that hurdle. You've paid down the debt, the fire is out, and your capital is finally freed up.
Oh.
The next immediate barrier you hit isn't picking the perfect stock, it's mastering your own biology. We are transitioning from the mathematics of debt to the psychology of investing.
And this is arguably the most treacherous part of the entire roadmap.
Oh, absolutely.
Human beings are just not naturally wired to be successful investors. Our evolutionary biology, the very instincts that kept us alive in the wilderness, actively works against us in modern financial markets.
Yeah, in the book, Collins lays out some very harsh, immutable truths about market dynamics. He states clearly that market crashes are frequent, they're entirely normal, and they're mathematically inevitable.
Right, it's not a matter of if but when.
Exactly. The market is going to drop, sometimes by 20, 30, or even 40%. But he pairs that terrifying reality with the historical fact that the market always recovers. And it has consistently trended upward over the long term, completely absorbing those periods of extreme short-term volatility.
But knowing that historically and surviving it emotionally are two totally different experiences.
Oh, completely.
Our sources dive into the behavioral biases that naturally lead investors to just destroy their own wealth. It fundamentally comes down to the mechanism of loss aversion.
Right, the pain of losing.
Neurologically, the pain you feel from losing $10,000 is roughly twice as intense as the pleasure you feel from gaining $10,000.
Wow, twice as intense.
Yeah. So when the market inevitably crashes, your cortisol spikes. Panic sets in. Your lizard brain screams at you that the bleeding will never stop, so you sell your investments at the absolute bottom just to stop the psychological pain.
You essentially buy high during periods of euphoria, and you sell low during periods of panic.
Which is the exact opposite of what you should do.
I always think of investing in the stock market like riding a massive roller coaster. You get strapped in, the car slowly clanks up the track, you crest the top, and then suddenly, boo, you hit a terrifying vertical drop. The wind is screaming, your stomach is in your throat, and every instinct tells you that you are in mortal danger. But here's the reality of the roller coaster. The only people who get seriously injured are the ones who try to unbuckle and jump off the car in the middle of the drop.
That analogy perfectly illustrates the core of Collins' philosophy. You have to understand the mechanics of the ride before you get on it.
Yeah, imagine watching your own accounts for a second. You've worked for years, you've saved up $50,000, and over the course of 3 brutal weeks in the news cycle, you watch a market crash evaporate, $15,000.
It makes you sick to your stomach.
You're down to 35. How do you actually react? because it is incredibly easy to say, oh, I'll hold strong, when your money is just sitting safely in a checking account.
And that is exactly why awareness of these emotional triggers is your single greatest financial asset. If you know the drop is a feature of the system, not a bug, you can brace yourself.
Right.
Collins advocates for an incredibly strict buy and hold methodology. You buy the assets and then you do absolutely nothing.
Nothing at all.
You endure the crashes, recognizing that historically the long-term trajectory is up. In this framework, building wealth requires much more emotional discipline than it does financial intellect.
So we've paid off the debt, we've strapped ourselves into the roller coaster, and our psychological armor is firmly in place. But how do we actually put this money to work?
Right, you need actual tools.
Knowing you're going to hold steady during a crash doesn't tell you what to actually buy.
Yeah.
Let's move from the mindset to the tangible mechanics. Let's open up the toolkit of simplicity.
Okay, so according to the source material, this is where the philosophy gets aggressively minimalist. Collins argues that to build and preserve massive wealth, you really only need two primary tools.
Just two.
Just two. The first, which he considers the ultimate engine of wealth accumulation, is VTSAX. That is the Vanguard Total Stock Market Index Fund.
Let's make sure we are crystal clear on the mechanics here. Instead of trying to guess which individual horse is going to win the race, an index fund like VTSAX essentially just buys the entire racetrack.
I love that.
You are buying a tiny fractional slice of virtually every publicly traded company in the United States.
Precisely. You aren't relying on some expensive fund manager to guess whether a specific tech startup will outperform a legacy bank. You are simply betting on the collective economic output of the entire American business landscape.
Right.
And the brilliant mechanism behind an index fund is that it is naturally self-cleansing through market cap weighting.
Okay, wait, how does that self-cleansing actually work?
So in a total stock market index, the amount of money invested in a company is proportional to its size. So if a massive company starts failing, say, a giant retail chain starts losing out to e-commerce, its stock price drops.
Okay.
As its value drops, it automatically takes up a smaller and smaller percentage of your index fund. If it eventually goes bankrupt, it just quietly falls out of the index entirely.
Oh, I see.
And conversely, as a new company innovates and grows, its footprint in your fund automatically expands. The index naturally weeds out the losers and rewards the winners, all without you having to read a single earnings report or, pay a manager to do it for you.
Here's where it gets really interesting, though. Because if you open any standard finance textbook, Chapter 1 is all about global diversification.
Right, you need a mix of everything.
They tell you that you need emerging market funds, European equities, real estate, commodities. But Collins looks at that and says, just buy the U.S. total stock market and go for a walk.
Yeah, he really does.
Wait a second. Why does he claim that investing solely in U.S. stocks is enough? Doesn't that expose you to massive geographic risk?
It is definitely one of his more debated stances, for sure. But his rationale is rooted in how globalized the economy has really become. Look at the largest companies driving the U.S. total stock market. You have Apple, Microsoft, Google, Coca-Cola.
Yeah.
These are technically American companies, but they are massive multinational conglomerates. A huge percentage of their revenue, often 40% or more, is generated overseas.
Oh, that makes sense.
They have operations, supply chains, and consumer bases across the globe. So Collins argues that by owning the total U.S. market, you inherently capture international exposure because these domestic companies are already deeply intertwined with international economies.
You are basically outsourcing the complex work of global diversification to the CEOs of those massive companies.
Exactly. And this points to the overarching theme of his method, which is that complexity introduces friction. Every time you add a new specialized fund to your portfolio, you usually incur higher management fees. You have to rebalance your portfolio more frequently. And honestly, most dangerously, you create more opportunities for your own behavioral biases to sneak in.
Oh, for sure. You might look at your emerging markets fund, see it underperforming, and decide to tinker with it.
Exactly. Simplicity mathematically lowers your costs, and it actively minimizes human error.
So VTSAX is the growth engine. But if I'm approaching retirement, I don't want an engine going 100 miles an hour right near a cliff.
Does Collins offer a brake pedal?
He does, and that is the second tool in the kit, VBTLX, which is the Vanguard Total Bond Market Index Fund.
Okay.
If stocks are the engine driving your net worth up, bonds are the shock absorbers. They provide stability and they generate consistent dividend income. They're designed to counterbalance the wild, unpredictable volatility of the stock market.
Right, and the sources outline that Collins breaks your financial life into two distinct stages to use these tools. First is the wealth accumulation stage.
Yeah. This is your working career. You're saving aggressively and trying to grow the pile. During this phase, Collins suggests you focus almost entirely on the growth engine, holding primarily or even 100% in stocks via VTSAX.
Because when you are working, a market crash doesn't actually hurt your daily life. I mean, you don't need to sell your investments to buy groceries because you have a salary.
Exactly.
But as you transition into the wealth preservation stage, when you actually retire and start living off that pile of money, the mechanics change. You face what economists call sequence of returns risk.
Which is terrifying.
It is. If the market crashes by 30% the day after you retire, and you are forced to sell your stocks at that massive loss just to pay your electric bill, your portfolio might never mathematically recover.
So how do we protect against that specific risk?
To mitigate that, the sources suggest shifting your allocation to a golden ratio for preservation, which is roughly 75% in stocks, 20% in bonds, and 5% in cash.
Now, 75% in stocks still sounds incredibly aggressive for someone who is retired. Why keep so much in the volatile growth engine?
Well, because retirement isn't a 5-year vacation, right? It can last 30 years or more.
But that's true.
If you move all your money into safe, stagnant bonds, inflation will slowly eat your purchasing power alive over 3 decades. You still desperately need the 75% in stocks to ensure your wealth outpaces inflation.
So the bonds and cash are just a buffer.
Exactly. The 20% in bonds and 5% in cash act as a bridge. If the stock market crashes, you don't touch your stocks. You live off the bonds and cash for the 2 or 3 years it takes for the stock market to recover. You use the shock absorbers to get through the pothole without damaging the engine.
That makes perfect sense. So we have the psychological armor and we have the tangible tools. The final piece of this puzzle is execution.
Yes.
How do we take this incredibly simple system and protect it from our own worst impulses? Let's talk about automation and tax strategy. Because, look, if I see the market crashing on the evening news, wouldn't it just be common sense to hit pause on my auto investing for a month and wait for the dust to settle?
That instinct right there is exactly why automation is mandatory. What you just described is market timing, and mathematically it is devastating. If you pause your investments during a crash, you are halting the exact mechanism that builds wealth during a downturn, which is dollar cost averaging.
Okay, let's break down the math of dollar cost averaging for the listener.
Think of it this way. If you automate your system to invest, say, $500 every single month, regardless of the news, the math just works in your favor.
Right.
When the market is high, your $500 buys fewer shares. But when the market crashes and everyone else is panicking, shares are effectively on sale.
Ah, I see.
That same automated $500 now buys a significantly higher number of shares.
Yeah.
You are systematically forcing yourself to buy more assets when they are cheap without requiring any willpower or decision-making on your part.
You completely remove the human element. The money leaves your checking account and buys the index fund before your emotional brain can even register it. But the sources also heavily emphasize where we put those automated investments. They stress maximizing tax-advantaged accounts, things like 401k, IRAs, and HSAs. We don't need to define what all those acronyms mean, but we do need to understand the mechanism of tax drag.
Tax drag is a silent killer of wealth. I mean, every dollar you pay in taxes on your investments is a dollar that cannot compound over the next 30 years.
Right.
By routing your investments through these legally protected accounts, you are shielding your money from the IRS, allowing the compounding interest to snowball entirely unimpeded.
And the source material actually provides a really brilliant distilled case study to show this in action. We are presented with a 26-year-old graduate.
Right, the 26-year-old.
Yeah, they have a solid salary, and crucially, they have no debt. The blueprint Collins gives them is ruthless. Use low-cost index funds, automatically maximize whatever employer match is available in their 401k, because an employer match is literally free money.
Never turn down free money.
Exactly. Maximize their other tax-advantaged accounts, and fiercely avoid relying on traditional, expensive financial advisors.
That final point about advisors cannot be overstated. We need to look at the mathematics of a standard 1% asset under management fee.
Yes, let's talk about that.
The industry pitches a 1% fee as negligible. It sounds like absolutely nothing. But you aren't just losing 1% of your money. You are losing the compounding growth that 1% would have generated over 40 years.
Right, if the market returns 8% and inflation needs 3%, Your real wealth is only growing at 5%.
Right.
If an advisor takes 1% off the top, they are actually confiscating 20% of your real growth every single year.
Exactly. Over a 30 or 40-year investing lifetime, that seemingly tiny 1% fee can mathematically consume nearly a third of your total potential wealth.
A third.
That's insane.
It is. By using simple index funds, you eliminate that parasitic drag on your portfolio entirely.
So what does this all mean? We're looking at a 26-year-old in this specific case study. But what if the listener joining us today is 46 or 56
Yeah.
and feeling like they are hopelessly late to the game? Does this blueprint still apply?
What's fascinating here is that the mathematical mechanics of this blueprint do not care about your age.
Right.
Not at all. The compounding power of VTSAX, the tax shielding mechanics of an IRA, the psychological necessity of holding firm through a crash, these are universal constants.
Okay.
A 26-year-old has the massive advantage of a long time horizon, but a 56-year-old often has the advantage of peak earning power and the legal ability to make larger catch-up contributions to their retirement accounts.
Oh, right.
The strategy remains exactly the same: automate the simplicity.
There is one mechanical warning for the future mentioned in the sources, though, specifically regarding those tax-advantaged accounts. If you use traditional pre-tax retirement accounts, you eventually run into RMDs, required minimum distributions.
Yes, the government allowed you to defer taxes on that money for decades, but they eventually mandate their cut.
Of course they do.
Currently, starting around age 73, the IRS forces you to start withdrawing a certain calculated percentage of those accounts every year, regardless of whether you actually need the money to live.
And because this forced withdrawal counts as a taxable income, it can unexpectedly bump you into a higher tax bracket in retirement.
Exactly. It requires some strategic planning later in life, but frankly, having so much money shielded in a retirement account that the government literally forces you to take some out is an incredibly good problem to have.
It's the ultimate luxury problem.
And it really is.
So let's pull all of this together and distill this deep dive down to its absolute core. If you take nothing else away from this roadmap to financial independence, burn these 4 pillars into your mind.
Number 1.
First, aggressively question your relationship with debt. Whether you view it as a mathematical tool for leverage or a psychological fire in your kitchen, you must respect its power to dictate your future choices. Second, brace your mind. The market will drop. The roller coaster will plummet. Expect it, accept the mechanics of it, and do not let loss aversion convince you to jump off the ride.
Stay in the seat.
Third, embrace the boring, brilliant mathematics of broad index funds like VTSAX and VBTLX. Stop trying to pick the winning horse. Just buy the racetrack and let the market naturally cleanse itself.
Love it.
And fourth, automate the entire machine. Shield your money from taxes and put your monthly investments on an unbreakable autopilot so your emotional brain cannot sabotage your future wealth.
If we connect this to the bigger picture, it really is a profound paradigm shift. The financial entertainment complex wants you constantly engaged, constantly worrying, and constantly trading.
Yep.
This philosophy asks you to do the hard work of setting up a mathematically sound system exactly once, and then to aggressively and intentionally ignore it.
And that leads to a deeply provocative thought to leave you with today. If this simple path allows you to completely automate your financial growth, if you can permanently step off that stressful treadmill of tracking individual stocks, monitoring interest rates, and panicking over financial news, what are you going to do with all the mental bandwidth and time you get back?
That's the real question.
At the beginning of this deep dive, we talked about feeling trapped in a jungle of financial jargon. If you take this paved path, you don't just arrive at the other side with a larger bank account. You arrive with your time, your focus, and your energy entirely your own. True wealth might not just be having enough money to live comfortably. True wealth might be the ultimate freedom to stop thinking about money altogether.